We're live. What's up, Investor Nation? We're back with our monthly update. Sorry we're a little late, but the boys are here, and we are ready to go with some good data in February. Here with the Capital Markets team, as always, Jack Davis and Bryan Ziegenfuse, and I'm your raspy host, Ryan. All right, jumping right into it, JD. Let's cover. So we're always going to start, guys, with our macro updates. So we're going to kick it over to JD to talk about where spreads are on the 2 and the 10.
Yeah, absolutely. Right now, 10-year sitting at 4.3. I think over the last few months, we've talked a lot about the different rate cuts and sort of the different movement in the lines here. But the thing I really want to point out this time is the lack of movement and the stability between the 2 and the 10. And so we've seen in 2025 sort of a return to a normal yield curve where it's not inverted. It's a normal positive sloping yield curve, and the spread between the 10 and the 2 are stable, which I think is really important because that sort of indicates a feeling of certainty in the market. And Ryan and I were just in New York meeting with one of our capital partners. Yep. And one of the things that stability does is sort of open up the securitization market. And so they mentioned how they were one of the things they were looking at in 2025 was, the securitization market. And so as the securitization market opens up, particularly in our sort of world, I think, that demand and that liquidity is going to help bring rates down a little bit, sort of as we look to the back half of 2025.
So the 2 and 10 are giving us predictability. Brian, anything you'd add there?
No, I think as of late, we've seen rates come down. They're moving every day. And so over the last week, probably 2 weeks, we've seen a little bit downtick in rates, and so that could give sign that there's a little bit less optimism around growth, around the economy, or a little bit more uncertainty, and so we're obviously paying a lot of attention to where rates are headed.
Yeah, I think a lot of that's the Trump tariff, scares, and we'll talk about Trump more on the next slide too. But I think he's thrown around the 25% number for automobiles, semiconductor chips, and pharmaceutical goods. And I think now that some of those tariffs may be starting to materialize a little bit, there's a little bit of fear around future economic growth,
sure,
which, does mean rates will come down. So, I guess you could look at the growth as negative, but maybe the rates coming down is positive. But yeah, like we saw 10-year come down 12 basis points today as some of those fears materialize. So there's hope.
Back it up before we go to the next slide. Securitization. Just bring it down to the consumer a little bit. What does that mean for the borrower? If we got a red hot securitization market, does that mean they're going to see lower cost of capital, more optionality for liquidity in the market? Give them a little sentiment on what that means.
Yeah, I think you nailed it in the question. I think when the securitization market's open, there's increased demand for the paper that we write. They want volume, which means we got to get volume, which means we'll be more creative for our borrowers and more aggressive for our borrowers. So I think it does help. I don't know if you would add anything, Brian.
Yeah, I mean, it clearly, so more demand for the securitization, so the bonds that they create from the security. Yep. As that demand increases, that ultimately translates in lower rates or tighter spreads out to the consumer, out to our borrowers. And so it's definitely positive. I mean, we've heard of, and there somebody just recently that we were speaking to in September and October, they just put out that they did a rated deal or almost completed with their rated deal, and so it's definitely an in vogue topic for our investors.
Good time to be a borrower.
Yeah,
I'm out of the lending business. We're in the fix and flip business now, guys. Right, 100% financing, red hot securitization. Right. Sign me up.
There we go.
All right, guys, moving right along. Unemployment and inflation, 2 big drivers. Everybody's watching. JD, kick us off.
Yeah, the big thing here is we saw non-farm payrolls, a lower non-farm payroll print, so less jobs being added to the economy in early Feb. So that actually brought rates down a little bit, but then right on the back of that, we got a pretty hot inflation print that negated any downward movement that there was in rates. With inflation coming in hot, there is another big inflation print coming out this Friday. It's the PCE index, which is what the Fed cares the most about. So keep your eyes out for that because that will certainly move markets if there's any surprises. Something I want to talk about, though, on the unemployment front is going back to Trump and Elon and DOGE and the moves that they're making on Capitol Hill. So in late January, early February, 2 million government workers got a mysterious email from this Office of Personnel Management, basically saying you're basically offering this delayed resignation program where you could leave now and we'll pay your salary for 8 months and then you're done, or you can choose to stay and return to the office full time. But that doesn't guarantee that you'll hold on to your job. That's just a decision you have to make. And I think when they initially rolled out the program, they were estimating 5 to 10% of the 2 million to take that offer, which would result in around 100 billion of savings. And already within a month of that, 75,000 have taken it. So you're already seeing some sort of real effort to sort of shrink this government workforce, and those effects will be felt in one way or another. I think the industries that they're particularly looking at cutting is like education and healthcare on top of this sort of government world. I was looking at Bureau of Labor statistics for just the education and health services sector, and since 2022, that has been like a ridiculously strong labor market with unemployment at like 2.5%, which is, in a lot of eyes of economists is probably a little too strong. So I think that's really where they're focusing. And I actually know from personal experience of like a buddy of mine, he works for CHOP in their research department. And every Friday, the way I keep in touch with my college friends is we give like updates about, how's life, how's work, all that. And he's like, it's so slow with all this cuts to our research and funding. I've got like no work to do. So, maybe in your job, you're not seeing it, but this effort to reduce the workforce and cut federal spending and hopefully ultimately the deficit is going on in the background.
Interesting. Yeah, Brian and I were talking about this morning, so I know you want to add some stuff onto that.
Yeah, I mean, negative. Yeah, it's definitely negative in the short term, like some pain in the short term. Hopefully, longer, out in the longer term. But I'm sitting at CHOP, looking, in a waiting room, and Penn's newspaper is sitting right there, and I open it up, and one of the first articles in the newspaper is NHI funding is getting cut, creating uncertainty in Penn's research program. Yep. And so you're clearly seeing whenever there's uncertainty, we always talk about this here is uncertainty. It basically creates this paralyzing effect. And so I think for our borrowers, when you're looking at the economies that you're investing in, yep, you have to take this into account. So if you're investing, we've picked on Florida a lot.
Let's pick on DC.
Let's pick on DC. Let's pick on West Philly a little bit, maybe. But Graduate Hospital. So as you're looking at some of those markets, I think you got to take that into account. Yep. It's gonna come through the economy, and so this is going to be. Jack hit on all the right stats. The education, the government healthcare and education, how that comes through in DC, and then how that trickles out to these economies where they were funding research or funding. I think we're finding out more what they were funding, and
sure.
And
So I think the overall thesis is good to summarize. There seems to be a lot of uncertainty, and the street's really watching, right? Watching and paying attention to see how this flows through the economy and what the data is going to show us. So hopefully we'll have more to talk about here in March as this kind of unfolds. All right, so we're going to move away from macro and into kind of some of the real estate fundamentals, excuse me, of investing that we've seen, and try to help guys and girls, investors alike, kind of make rationale of how to look at investments today, maybe a little bit differently than they did, when free money was running around. Yeah. So we're jumping into this. We're going to kick it over to Brian to kind of start kind of the underwriting thesis and definitely how we think about it and maybe share some insights.
Yeah. Jump in as we go through this here. There's no easy way to explain this underwriting kind of black box methodology that whether it's us or different firms on the street, the smart money, what they do and how they do it. So we're trying to simplify it. If it's complicated, that's a good thing. You just gotta, just embrace it and figure it out as an opportunity to learn some more. And so So we put on here, so a real estate transaction, a property value, property worth $100,000. You're putting leverage against that property, and whatever's not leveraged or debt is equity. That's really your asset. And so when you're looking at debt and leverage against a project, so if you have no real estate, traditionally increases 2 to 3% a year. That's typically what it runs out. Some years more, some years less. And so if you have no leverage on that property, your asset's going to appreciate, or your equity is going to appreciate. Your return's going to be 2 to 3% a year. And so leverage gives you the ability to earn 10%, 15%, 20%. Depending upon that leverage. So that gets really enticing. That's right. Is those equity returns. But with that, what we want you to do as investors is take into account the underlying asset. When you look at the variables of that property, is make that a determining factor of maybe how much leverage you'd want to place against that property. Yep. And so maybe if it's, and so we'll go through some more examples, but like vanilla properties maybe can get a little bit more leverage, or it's easy to rent. It's main and main, as we talk about, or it's a Class A property. But as you enter different, out on the spectrum, harder to model, harder to price, maybe rural where it's not on main and main, or, different aspects that sometimes make real estate, it draws you to it because of the opportunity. Those variables can result in, in a higher fluctuation of property values, and we'll talk through that. But a couple things for everybody to be aware of is, location, super important. Rent income, so the stability around the rent income. If you get if you're purchasing a multifamily property and it's very hard to diagnose how much rent the borrower was actually collected. Is he getting the same thing every month, or does he have a lot of vacancies? He's got, issues. That lack of stability introduces a highly variable kind of property. So market supply, market supply and demand, repairs and depreciation, operating costs. So one of the things that we, as we were walking through these slides beforehand, was that comes into like Section 8 tenants, Section 8 properties. They typically, when you're modeling those out and you look at a T12, typically the repairs, the depreciation is going to be a lot higher than some other properties for various reasons. So, so we wanted to showcase this as a mechanism that maybe not every property you want to go max leverage on, even though as lenders we're going to say, sure, here's your options. Take a conservative, in some properties, take a conservative approach so that you have the ability to withstand some of the variables.
Yeah. So with scale comes profitability. We're kind of bringing you back to what profitability should look like versus scale and when to use leverage. Right. So Ray Dalio said it best on All In the other day. He's like, debt service is leverage is good, assuming that it makes more income to cover your debt service. And if it doesn't, then it becomes restrictive. And if that restrictive capital happens over and over again, you then have a domino effect. And we've seen a lot of guys that go out and do 10 properties. Like, I'm doing 10 properties for the sake of doing 10 properties, but they're not profitable. Do 5 properties and be profitable and maybe have a lower debt. And you might have better return on equity. Your investors might be happier, and your lenders probably aren't calling you. But we'll talk about it. So I think that's great. So we're going to talk about location, rent income, market supply, repairs, operating costs, and then kind of how that looks on a bell curve, right, or on a kind of standard deviation format, which is next. And if you're on the outliers, what happens and how you sensitivity test if you're on the outliers to those rent assumptions, those repair assumptions, those op costs. So Brian, maybe, or Jack, feel free.
Yeah. So like Brian said, if you're maxing your leverage to try to, because you like what that does to your potential equity return, it can juice it in the positive way, but the same effect can happen in the negative way. And that's what we're trying to show here on the bell curve. So take a zip code where the average home value is $300K. And it goes back to this variability component. So if you are looking at properties in a zip code where the average home value is 300K and you're looking, from the 2 to 400K, you're sort of in that range where asset value, asset variability one way or another is probably going to be somewhat stable. So if you're in that band with the property you're investing in, and that market as a whole either appreciates 5% or depreciates 5%, you could expect the same to happen to your asset that's in that band. But the further out that you move from that band, the more variability you'll see. So if you're looking at a luxury deal that's $2 million, but maybe that market depreciates 5%, you may see the value of that house depreciate 10, 15, 20%. Same goes if you're looking at Section 8 house, or if you're looking at, real cheap housing in a more affluent area. Sure. If that market moves 5% one way or the other, you're going to see it compounded when you're out on the ends of this curve.
So if you're buying at the bookends, guys, you really want to dig into some of the sensitivity analysis that we outlined on the first page, because that's where you can sensitivity test your project and make sure you're putting adequate leverage on there, or that the project actually makes sense if you see a market depreciation or you see rent slide because it's a classy neighborhood and those folks have a higher probability of being laid off, et cetera.
And it gives you, last point is, if you dive in, if you spend the time diving in, it'll give you better leverage and knowledge to be able to negotiate maybe a better deal.
Yeah, when you show up your lender and you know your market and you know these sensitivity analysis, they're going to be more prone to give you the leverage that you want versus Jack going, nope, I don't like that leverage. All right, guys, so we're going to jump into actually a live example. It's probably small, so we can always send you these slides too, or you guys can come in and we'll underwrite a deal, as we're going to talk about later. But Brian, maybe walk us through the math here on a 30-year DSCR loan.
Yeah, so we gave you a example of a 30-year fixed project that refinance, went through, acquired the property, they went through a refinance, got the permanent deal done. We just showed what the impact interest rates here could have as a variable against the project. And sometimes what you'll see is like a compounding effect. So interest rates moved higher. And as we've seen rents, maybe stabilize or come down a little bit. Property values in most markets have come down a little bit. And so you see this natural compounding across, multiple variables. And that's like the opposite of hedging. And so that's the worst case scenario, is what you don't want. And so you have your base case scenario where we said, all right, 5.5 interest rate, 25, you're collecting $2,500 a month in rent. Property's worth $500K. If you had a big portfolio across multiple assets here, that results on the bottom of 1.16 DSCR. That ties back into what Ryan was saying, is like, leverage can actually, if you're not covering your debt service ratio, it becomes an inhibitor. And so you're at a 75 loan to value. On the upside. So this, if you take rates down, you're going to see your DSCR improve. Same statistics, you're at 1.3, and then again on the downside, rates going higher. Now you're in a negative spot because you need that much leverage against the project, and therefore your debt service is going to fall down to 1. And so that's why monitoring and managing your leverage, if you didn't have as much leverage, if you didn't, in this case, start out at 75, if you didn't have as much leverage, you could withstand that fallback in debt to service.
Or if you're going to have that leverage, make sure you have cash on hand should interest rates slide. Because one of the things we've learned is no one thought it was going to run 500 basis points, but we've learned how sensitive real estate is to interest rates. And so, to Jack's point earlier, the stability allows for less of this, but the last couple of years we've seen a ton of this, right? And people have gotten hurt, and then they didn't have cash on hand because they did 10 projects, and they were maxed out on leverage, and they couldn't cover, and properties are sitting longer, and they didn't capitulate.
That's right.
And as you know, as he talked about the compounding effect, if you get stuck in default interest or you get stuck paying extension fees, that erodes your equity immediately. And so you're better off taking the return on equity and moving the project faster, making a little bit less, but turning those dollars over again so your investors are happy. We're going to have a different segment on return on equity, but it's a super important concept that as an investor, when we started this business, I wasn't even astute to, and I've learned from the capital markets guy how important it is and why the national home builders look on return on invested capital versus just cash on cash and kind of actual dollars. So we talk more about that. But it's a great example, Brian. Jack, anything to add before we leave?
No, I guess, and then I would just say, like, you know, in the downside scenario, like, your options are going to be limited on how you can get out of it, which is why it's super important to stress this stuff in advance and really think about, all right, if this did happen, what would my options be and how would I be ready to get out of it?
And if you have a deal you're unsure about that sits on the bookend, send it in. We want to underwrite it for you. We want to show you how to do this. The whole point of this webinar is for us to help you not make the mistakes that we've made and we've seen others make. All right, the BRRRR method. This has been in fashion, in vogue for a long time. It's almost as bad as Uggs for women in women's fashion. Sorry, I should know that, but I do. So we're going to talk a little bit about the BRRRR, where to use it, and then maybe how to think about it in today's landscape versus maybe what it was when there was free money running around. So
that's right. Yeah, it's a great marketing. You know, it's a great technique. It's a great marketing component to be able to explain how to invest, especially if you're young, you know, you're just starting out investing. Here's a methodology to follow, and it definitely makes sense. I mean, we're in the fix and flip business, and it makes, you know, fix to rent. We do this all day long, and you know, we've got loan products that support this, and so the BRRRR method is this buy, renovate, rent, refinance, and repeat process. And so when interest rates were lower, when the spread and the profitability between kind of that unimproved to improved market was wide, at some point, you know, 2015, 2016, super wide. And so so it still presents opportunities today, but this approach, as we've come more and more, more of our investors do this, we've noticed some drawbacks to the BRRRR method that we thought we'd share with the team here, our investors, because it's clear. It's one of the things we look at a regular basis so that you don't become over leveraged, because that's that's the last thing you want. And so what typically happens? A borrower is going to buy a property. They're going to put in repairs in order to get it rent ready. And so those repair costs can be $50,000, $60,000, $70,000. You know, maybe it's a major renovation, and then they place a tenant in the property, and then they put it into one of our DSCR loans, and then they take those funds. They essentially replenish their capital stack, or refill their capital stack when the refinance happens, and then they buy the next property and the next property, and continue to repeat this, building up an investment portfolio. And so we allow the ability to go, for customers to go do this. And so the big drawback that we've seen, as full transparency as that we could provide out to our borrowers, is when you get into the quality of the repairs, if you're selling the place, you're going to put in the GE, you're going to put in the GE appliances if you're selling the place, versus maybe if you're renting the place, you're going to put in Frigidaire. And, maybe your countertops aren't as nice. Your cabinets are, instead of maybe semi-custom, they're Home Depot, or, things. I mean, there's plenty of examples like that.
Glued and screwed.
Yeah.
Dovetailed.
And then when we go and value the property, we're looking at places that were sold. And this is just naturally, there's not a good way around it, but appraisal companies need to look at look at what has sold, and to take into account those sales. There's a chance that they were repaired for a for sale product. And so you can get some inflated valuations when it comes to that refinance element of it. And so that's one of the areas that we see, is we call it lipstick on a pig, where you're not quite, you're not making it as nice as the for sale. But and so on our next, go ahead.
No, I was going to say, and you're just not adding value. You're not adding a bathroom. You're not adding square feet. You're not fundamentally changing the envelope of the building. And so, therefore, it's not going to stack up to a new construction or a fully rented home for sale in your market. And so you can't Brian's favorite word, you can't manufacture that yield. And then your interest rates are higher, so theoretically your asset value is probably lower. And so now you're stuck. And we've seen a lot of this over the last couple years.
That's right. And so, I call it manufacturing money. It's like this isn't it's not a job. You're not going to make hundreds of $1,000s from doing this, or you shouldn't.
Or Brian would already be doing it.
That's right. He invented it when money was free. Yeah.
Jack, anything you'd add here on the drawbacks? Because you're underwriting a lot of deals now.
Yeah, I would just going back to it was fine when money was free.
Yep.
And now it's not. And so now there's, and we've just seen for some of our own borrowers where we've done the fixed to rent loan, and then it's ready for the and they push for max leverage maybe on the fixed to rent loan, and now it's time to refinance, but rates are higher, and now the DSCR is worse. So on the refinance, they're not qualifying for that 75 LTV cash out. So they got to take 70. So they're not recouping as much money as they wanted to. And so, we're really seeing it, and it's just something to really be mindful of as you operate your business. Yeah.
When you see guys do it over a big portfolio, what's really going to happen? Because that forced appreciation isn't going to happen for the next it's going to be slower over the next couple of years, theoretically, unless we go down to free money again, which is probably unlikely. So you're going to have to raise more capital if you want to do more velocity of deals, because your money's going to be stuck in the project, and that's okay. You're going to be at a good leverage. You're going to slowly grow the portfolio. You're going to season that portfolio, and you're going to go raise more capital and do more deals. And that's just kind of the cycle we're in. I think guys are waiting for rates to capitulate, to come back down, to refinance, and that may or may not happen, depending on what we have with employment, right? Here in kind of this Trump shakeup.
That's right. And as your portfolio seasons, you're naturally deleveraging because you got 2 to 3% appreciation, and then you have an amortizing loan that should pay it off each month. So
the rents are flat now, and as that wage gap and that house price kind of gap comes together and wages increase, you're going to see a natural progression of rents tick up. And like Brian said, you're going to season that portfolio. You can pay down more debt, and it's all going to be okay. You can't buy the Lambo today. You're going to have to buy it in 3 years. Yep. All right, guys, moving right along. Anything else you'd add?
Yeah, this is our best. So we come across these projects. Click on the. Yeah. Yep. This is an example of what we're trying to show. I felt this is one that just popped up. If this is no offense that we're cherry picking one that's recent, but here's a property that's above, bought it for $275, put some money into it. The comparables that came back on the appraisal on the bottom, as you can see, they're brand new construction projects. Yep. They're very nice. And as we talk about in real estate, location, curb appeal, those things are real. And so,
district.
So this this borrower could they got an appraisal at $450. The other one's largely dictated on the properties below, and they could take 70, 75, 80% leverage. They'll be above their cost basis. And so, we've got, as you can see above, it's pretty clear to us that just looking at the, kind of the curb appeal, that these are superior properties. And so, be realistic. The last thing we want is don't turn an asset into a liability by over leveraging this thing.
So the whole goal of this webinar is to give you guys live market updates, but also share kind of learning curves. Over $2 billion in loans. These guys have seen a lot of mistakes, and we've also made mistakes in our own portfolios. So one of the things we wanted to offer up today was anybody's got a live deal that they're unsure about. There's no dumb questions. Come in. Let us help you underwrite it. Let us think through it with you. We've done a lot of loans, as I said, and so I think that's a really cool opportunity if you have a deal to showcase it, whether you use us or not. Let us be a resource for you, and hopefully we can add value and be advisors.
Kush is a secret weapon down there, so that's the email to reach out to.
Kush. Kush is our lead analyst. He's a stud. So, all right, guys, we're going to open it up for questions, and so hit us. And if you are watching this on IG or LinkedIn, hit a like or subscribe.
That's right.
We're going to be coming back, streaming it more often, which is cool. We're finally tech enabled over here at iFund Cities. How?
I have an LTV. You do a BRRRR with 720 FICO.
Good.
I think we can go all the way up to 75. And if it's like a purchase transaction or a rate and term, we'd go all the way up to 80.
We'll look at the appraisal though.
Yeah, we will look at the appraisal.
Yeah.
Yeah.
If max LTV is your goal, there's probably some other lenders that'll capitulate for you.
Yeah.
Go ahead, JD.
How much do you think interest rates will fall given the new fears of layoffs and recent risk-off sentiment?
Great question.
Yeah, I mean,
Shooting from the hip. We don't know the answers. So
yeah,
we're just
shooting from the hip. 10 years out, 4.3. Maybe by the end of the year, we're 375, 4. Probably more like 4. I don't know. I think the big thing is I don't think we'll go under 4 by the end of the year. But if we can keep sort of a positive sloping normal yield curve, then I think we could see some positive moves in affordability as a whole. Yeah.
Yeah, I mean the only thing I just think that we should at some point see this spread on mortgages, the treasuries tighten versus the 10-year dropping. But I don't know. I still would love to see a 5.75 to 6% 30-year fixed mortgage.
Brian wants that market unlocked.
Yeah. Get us down to the low 6s.
So between government cut spending, right, and maybe rate drops, we kind of normalize. But I think at the end of the day, we want predictability, whether that's 4.5 or whether that's 4. You want predictability in the market. So whatever that unemployment data shows as DOGE goes and does its thing, we really want to see that trickle through and get some stability, right? Because that'll give these guys the ability to not have that.
Bring that spread in, yeah.
Correct.
Yeah. So.
Does the capital markets team use the 10-year as an index still, or has there been a shift to the 5-year as a better indicator?
I've always looked at the 10. I don't know.
Yeah, it's a more. I mean, I think you look at the total yield curve in totality if you're running models, if you're like your capital markets team is actually pricing things out. Like I think you look at the totality across the curve, depending upon the asset that you're originating. It's the easier. Like 2s versus 10s is just a common area on the curves where there's a lot of trading activity. There's hedging activity. There's trading activity. They're liquid points. They're super liquid points, and those are the ones that folks focus on for various reasons. But you're clearly, if you have a 5-year, a predicted 5-year asset in the mortgages, you're going to look at the 5-year part of the curve, just as another benchmark. But 10 years is kind of what everybody's been grounded into.
Go ahead, JD.
Is it typically advisable to raise private capital and or buy the land outright first, then secure construction financing? Or do hard money lenders prefer to fund both the land acquisition and construction together?
It's going to depend on the leverage in the project is the answer to that question. But I think for us, we have an appetite for both the AD and the AD and C, depending on what the investor is looking to accomplish, and then depending on the scope of the A and D. I think the key to that is understanding your development timeline if you're doing the A and D and what's actually needed to get that land to an improvable component where we can actually build the project.
Yeah. I think you marry up. One of the things you would do in this situation is marry up your pro forma against your capital and allocate it accordingly. Like as a lender, if you have a project that's fully entitled, permits in hand, maybe you're already breaking ground, like that, those are things it's like it's easy to see. Versus when there's more unknowns, uncertainty, as we always talk about, around when are you going to get the permits? Are you going to get, like, that timeline can introduce or could introduce more kind of variability into a project. And so, of course, we would love to fund the construction after you have permits and plans and approvals. But I think you've got to marry up your pro forma to how it matches your capital.
I'd say one other point is our bigger developers have a pocket of cash in which they're kind of doing the pre-development work, and then we're refinancing them at close and giving them money back to the improvements that they made on the land. So having that stash of cash, if you're raising private capital, that's a great place to put private capital. And I'd argue today with where rates are at for alternative money, hard money, like you could really beat on the equity to get it into a preferable kind of cost structure for yourself today. What is a typical ROI or IRR iFund Cities looks at on a project?
Positive return on investment.
Positive return. Yeah. I mean, I think when you look at IRRs, everybody does a benchmark analysis. So like the stock market's here, treasuries are here. You're benchmarking different. How complex is the project? So is it spec land that has
rural?
Yeah, rural. And so I think you kind of have a grid that you outline your IRRs, and you're going to have a upward sloping kind of curve that you could layer against different project types. Like a single family fix and flip project, the IRR tolerance is going to be it's going to be a lot lower than something new construction, land development. And so to give you some numbers, you could be anywhere between, for like equity in a deal, 15 to 30% feels like a good range on those projects, with most of it falling in kind of, I would think, like 18 to low 20s. Yeah. Is that
on a multi with a pref promote structure? Yeah, it's like an 8 pref and 25 to 50 promote, depending on this, like you said, where you at in the spectrum. Are you close to that norm, or are you out on those bell curves that we talked about on those bookends? Right. But I'd argue you can borrow debt cheaper than that. So I don't. Yeah. It's the new equity. Do you have any seasoning requirements for DSCR rental loans? Do you lend off your own balance sheet, sell in the secondary market? So we have a combination of both. We have a $200 million balance sheet, so a lot of capacity to do balance sheet loans. That continues to grow. That will continue to be part of our strategy to support investors, especially if it's a non-vanilla project that doesn't fit capital markets. We do trade loans on the secondary, both the RTL, which are your fix and flip and new construction, and then your DSCRs are always traded due to kind of where the interest rate is and where the cost of capital is for a hard money lender today. They all get traded in the secondary market.
Yep. And then on the seasoning piece, if you're looking for a cash out refinance for a DSCR loan, we're typically looking for 6 months seasoning. There are circumstances where we can look at it between 3 and 6 months, but again, we're going to be really careful with the appraisal and what your cost basis, what you've put into it, to go against that example that Brian just walked us through of 275, 50K renovation. Now it's worth 450. We're going to be wary of that, and seasoning is something we look at when we're evaluating that. Is 90 loan to cost too high for my upcoming new project that is new construction?
You want to take that, Brian?
Send it in.
Brian loves new construction at 90.
Send it in. Let's take a look at it. Send it over to Kush, and let's take a look.
Kush.shaw@ifundcities.com.
But to answer that question, again, if it's in a stable market in Charlotte, North Carolina, with great school districts and great mobility in terms of infrastructure and the ability to move around with good fundamentals, you're probably going to be in a production housing sub 750, 500 and below. You're probably okay. That velocity of that market's probably strong enough. If you're on one of those bookends in West Philadelphia, probably not a good idea unless you have capital reserves should something change on you pretty quickly, whether that be rent, market, any of the variables we talked about today.
Yeah. If you're out on that bell curve for that zip code, then yes, 90 is probably too high.
Go ahead, JD.
Once I've completed the horizontal work and obtained permits, what percentage of my total investment can I expect to be reimbursed when securing the vertical construction loan? For example, if I purchase a lot for $100K and invest 25 in site work and permits, how much of that 125 would typically get reimbursed?
Again, this is one I'm going to answer the way Bryce said. Like, I think send it in, let us look at it. It's kind of circumstantial. It's, what's your credit profile, what's your experience, what's the market, where is it? In general, you're going to be at 65 to 70 LTV up front with 100% construction financing, capped at 70 to 75% of the ARV, depending on the market and where you sit in that bell curve and all the other variables. But I'd say we're super competitive there, and you should send it in. We should at least look at the deal.
Well, yeah, like we're gonna try to reimburse them. It's just it depends on the specific numbers and the specific project. But I love that they're asking about specific deals. Send them in, please. Send them in.
We do vertical. So does iFund Cities do vertical construction on luxury homes? And the answer is we don't love it. We've done a lot of it, so we have a lot of insight as to what works and what doesn't work. We really like to cap it at $3 million. Again, market specific. So yes, that's another one. Send it in. If it's in Wayne, Pennsylvania, we're probably more apt to do it than if it's in West Philadelphia, for another bad example. Yeah. Or if it's in, Davis Island in Tampa, we're probably more apt to do it than if it's in Fort Myers, right? So depending on your market, your experience, we'll look at it for sure.
Yep.
Good questions. This is most questions we've got.
That's good.
Let's go.
Send the deals in.
Bring the deals. And if nothing else, guys, even if you bring the deals and we give you an insight and you go to another lender, at least you've got 2 or 3 perspectives to then help you guide you on how you're underwriting deals moving forward, which is our goal. All right, guys, that's it for the questions. We'll be back in March, hopefully with some more market information. So, boys, we appreciate you giving the insights today.
Yeah.
Yeah.
Cheers.
Thank you.
Take
Thank
care.
you.